So negativity once again, and really we're worried about this political scenario in the Eurozone, and without getting into too much detail, because I'm sure the viewers and you and everyone else is so sick of hearing of Greece. But what is your prognosis on the scenario? Is there a concern on your end that things could deteriorate further?
Yeah, look, I mean, the situation in Greece isn't very pretty at all. One of the worst things you can have for your banking system is to have a run on your banks. That's when the depositors all come and they want their money back, because banks borrow money from depositors at the short end and they lend money long. So they lend you money for 20 years to buy a house. So if you go and say, I want my money back today, they can't give it back to you. So that's why you have lenders of last resort like the Reserve Bank and the ECB after that. And you've heard ECB, there's noises that they say they're not going to lend to some of these Greek banks. So there's a big problem.
They're not lending under the regular structure, but
they're going to rather lend to the
in the emergency, which I actually still haven't done enough research to figure out what the emergency assistance is relative to the regular assistance. Well, either way, they're assisting.
They say they're going to lend to the Greek government, but not directly to the banks. So there is a problem. If I was living in Greece right now and I had a deposit in a Greek bank, I'd be withdrawing it.
So you're not, looking at the massive deposits, the withdrawals that have been going out of the Greek banks and saying, well, what are these Greek people doing? It actually makes sense, doesn't it?
Oh, it does make sense. I mean, even if it's not actually new information, because if you look at the last 12 months, the Greek banks have lost 17% of all their deposits.
Absolutely.
So there's some people who are a little bit ahead of the curve.
Absolutely. Okay, so let's just touch on the market. We're down 0.8%. Resources still coming under pressure. Banks slightly higher. We had some interesting news coming through from the Reserve Bank yesterday saying that it will increase liquidity into the banking system into 2013 under a different model. So in other words, interbank lending is not going to occur as much as it will occur straight with the Reserve Bank.
Sure.
Is this going to change the liquidity scenario? And this obviously as we move to Basel III.
Well, I mean, the South African banks are actually in a very strong position. They are very well capitalized. I know under Basel III, one of the requirements is they want to try and get a better match between the lending that the banks do and the deposit taking that they do.
Absolutely.
Because they want to close that liquidity match so that you don't have a run on the banks. But in South Africa, there's a very wide gap between the two. Most South African banks are borrowing from you and me at overnight lending rates, and they're lending 20 years in terms of home mortgages. So that is a risk that they want them to get it closer, and you see the banks, they are starting to do it. It means that obviously they're going to make less interest margins. Not great for bank profitability, but I mean, I don't see the South African banks having a major problem in this
Okay,
regard.
is this a good enough reason then to buy into the banking stocks? And I mean, you just mentioned that low profitability for banks going forward, and we just had some numbers out of, Investec, which is more of an investment bank. But what is your view on the banking sector?
Well, I mean, the banking sector is probably in a broad range of fair value. I mean, we do own Standard Bank and ABSA. It's 12 months ago, it was screaming at us, hey, we must buy it, so we had a lot of it. We've reduced recently. I mean, the banking stocks have done well. But I mean, they're not hideously expensive. I mean, if I had to say what's hideously expensive, I'll probably look and say retailers. Their margin, their multiples that you pay for retailers now they're quite stretched. So banks, I'd be a holder of a bank.
Let's touch on Investec, and Investec came out with a 29% drop in annual headline earnings per share, 26.8 pence, and again, bad loans coming through in Australia. Weak performance in the investment banking space, so not a very pretty scenario. And Investec for such a long time actually held very close to that sort of 0% level where we didn't see headline earnings per share doing very much, and then just slowly edged into negative.
Well, I mean, the thing, if you look at Investec, in their first half of the year, they made about 17p. In this half, they've only made about 8. So, I mean, their earnings have really fallen off a cliff. But, I mean, there is a bit of kitchen sinking. I mean, if the management team are Investec and you're looking at it and you're going, you know what, we're going to miss it. Let's go find all the things that might go bad, and we'll put it into this half year. That said, I mean, I was going through the detail on Investec. There are some things that really worry me. They bought Kensington in 2007. They paid way too much for it in my mind. And if you look at it, I mean, the loan to value on that portfolio sits at 105%. So, and their exposure.
And they've actually made quite a few acquisitions over the past while, in fact.
Well, I mean, I think Investec's identified that you don't want to be an investment bank any longer. So they're going, well, what are we going to do? We're going to morph ourselves into an asset manager.
So, I mean, what would you want to do? What would you want to have exposure to? The banks that are starting to gear themselves to unsecured lending, where you're seeing much higher margins, and we're not seeing the PEs of these banks that are starting to increase unsecured lending to the level that what we see with Capitec, which is sitting at a much higher PE. How would you, start saying, well, these are the banks I'm going to pick? How would you classify that?
Well, I mean, we own Capitec, we don't own Investec.
So you're lucky, and you probably bought it at the right time, isn't that
well,
so?
we held Investec, we sold it about a year ago.
Yeah.
I'm quite glad we did. I mean, it hasn't done well at all. But I mean, Investec's got a lot of problems. I mean, you can go through the detail and get quite scared about everything.
Yeah.
But then if you take one step back, it's trading at 1 times net tangible and asset value. So I mean, it's not expensive on that basis. They're talking about a long-term ROE between 12 and 16%. So, maybe it should trade at a slightly higher price. I mean, it's got a dividend yield of 5%. I know they've kept their dividend. So, I mean, it's not all bad, and you've got an experienced management team.
Okay, so PPC headline earnings per share up 8%. This is very exciting. The we start to see cement sales looking far better. I wish Paul Turan was here because he loves the stock.
Sure.
Are you getting optimistic on PPC?
Well, the thing that I worry about the cement sector is if you look at Sepaku's coming online with more cement capacity, and cement's not we're not at maximum capacity utilization. So I worry that longer term, there's a new competitor coming into the market.
Yeah.
And that's not good for pricing.
Absolutely.
Or profitability.
Okay, thank you so very much, Jonathan. We have to leave it there. Thank you so very much for joining us.